The U.S. government has announced plans to waive tariffs on certain imported goods, but this move is being met with criticism from some lawmakers who argue it could hurt American businesses. On the other hand, proponents of the plan say it could help reduce inflation and make goods more affordable for consumers. In other news, a recent report from Tata Mutual Fund suggests that investors may want to consider allocating 70% of their portfolio to gold and 30% to silver. The report cites geopolitical uncertainty and supply chain disruptions as key factors that could drive up demand for these precious metals. However, it's worth noting that some experts are cautioning against putting too much emphasis on gold and silver, arguing that other assets such as stocks and bonds may offer more stable returns in the long term. Whether you're a seasoned investor or just starting out, we're here to provide you with the information you need to navigate the complex world of finance. From trade policies to investment strategies, we'll cover it all on the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and technology, where two companies, Cerebrus Incorporated, Cerebrus Inc., a leading AI computing firm, and Mercury Systems, Inc., a prominent player in the defense industry, have made headlines with their recent earnings reports. Let's start with Cerebrus Inc.'s competitor, Cerebrus Systems' peer company, as an example. The company reported record orders and a significant increase in backlog, but its shares fell due to concerns over the conversion of these orders into revenue and profit. This raises important questions about the gap between demand and financial performance. On the other hand, Mercury Systems, Incorporated also reported record orders, with a book-to-bill ratio of 2.28 and a backlog exceeding $1.9 billion. However, its adjusted earnings per share missed consensus estimates and its operating cash flow declined. The company expects fiscal 2027 revenue to approach $1.1 billion, with adjusted EBITDA margin expansion, but the proof will be in the pudding. It's essential to consider both the bull and bear cases for these companies. On one hand, record demand and increasing backlog can drive earnings inflection and growth. On the other hand, the conversion of orders into revenue and profit, as well as cash flow generation, are crucial factors that investors should closely monitor. As we analyze these stories, it's clear that the relationship between demand, financial performance, and investor expectations is complex. While some companies may excel in one area, they may struggle in others. It's crucial for investors to remain vigilant and consider multiple perspectives before making informed decisions. Welcome back to the Riskwiser Zone. Today, we've been exploring the exciting world of space stocks, and I'd like to leave you with a thought-provoking comparison between three key players in this sector: Rocket Lab, S T SpaceMobile, and Karman. As we weigh the pros and cons of each company, it's essential to separate the compelling narratives from the financial realities. On one hand, Rocket Lab and AST are selling a vision of the future, a future where humanity expands into space and dead zones become a thing of the past. Their stories are captivating, and their potential for growth is undeniable. However, this comes with a significant amount of risk, as their valuations are largely based on promises yet to be fulfilled. On the other hand, Karman is a company that is already demonstrating its value through profitability and steady growth. While their story might not be as flashy as the others, they're providing essential hardware for the space industry with a clear track record of success. The question is, why are investors willing to pay such a high premium for Rocket Lab and AST, while Karman trades at a relatively lower valuation? It ultimately comes down to the type of investment you are looking to make. If you're willing to take on more risk in pursuit of potentially astronomical returns, then Rocket Lab or AST might be the better choice for you. However, if you prefer a more stable, proven investment with a clearer path to growth, Karman could be the way to go. As we conclude today's episode, I want to emphasize the importance of doing your own research and considering multiple perspectives before making any investment decisions. It's crucial to separate hype from substance and to prioritize a thorough understanding of each company's financials and potential risks. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.